If you had invested 25 lakhs in direct stocks, you would be poorer today than if you had done nothing. In a moment, I will show you a portfolio graph, a return graph, that could make you question every single stock that you hold in your portfolio. But the real story is not just about poor returns. It's about why this happens again and again, and no matter how smart you think you are. Now, I know this video might challenge your belief as an investor, but for most of you, what I'm about to share will also be a rude shock. Not because the numbers are looking bad, but because the pattern behind them is impossible to ignore. I must admit, there are a few rare exceptional people, handful of investors. They have the tools and skills like a professional fund manager. But for the rest of us, this data exposes a silent portfolio killer, direct stock investing, what works for years before showing its true damage. And once you see it, you cannot unsee it. A massive study was done by Professor Barber and Odean. They researched 66,000 investors who bought and sold stocks directly. The result was shocking, and you might not believe it. The very active direct stock investor, constantly researching, buying, selling, his portfolio earned 6.5% less per year than an index mutual fund. So in their research, the direct stock investor, he earned 11.4% return per year, and the market returned 17.9%. That's a huge gap. The smart, patient buy and hold investor who rarely bought and sold, held for long term, he still earned 1.5% less per year than the market. So whether you are investing in the next big thing or you are calmly holding on high quality momentum stocks, both these groups underperformed compared to the index. Now, if you think you are an exception, this data says otherwise. And for the context, the first group had an annual portfolio churn of 75%. If you buy and sell more than 75% of your holdings in a year, this research suggests you could lose 1/3 of your potential wealth in just 5 years. The second group traded far less, yet over 20 years, 1.5% per year underperformance could wipe out half your wealth. Now, why does this happen again and again? We will discuss that in a minute. And this does not even include short-term capital gains that you may have to give on your profit. If you want the full research report, please ask in the comment section and I will share it with you. Now let me share another insight. Let us look at the portfolio turnover ratio of one of the oldest flexi-cap funds. It's 39%. So roughly 4 out of every 10 rupees of stock held have changed, meaning they were bought and sold. So if you're an individual stock investor trying to beat this fund, you may end up with slightly more or similar churn, and this will show you in your underperformance versus the benchmark, and that could range between 1.5% to 6.5% per year. Let's take an average figure of 3% per year for illustration. Suppose you churn 40% of your portfolio in a year and you generate say 12% total return after the expense ratio of the fund, that is after factoring all the expenses, then it would mean 40% of your portfolio's gains are likely taxed at short-term capital gains rates. Very roughly speaking, gains from your churn is 40% of 12%, which is 4.8% of your portfolio value. Short-term capital gains approximately 20% of this, that will be about 1% drag on return. And when you combine it with 3% underperformance, with this 1% tax drag, you are 4% behind per year compared to simply investing in a mutual fund index. Over 5 years, that's like losing 20% of your wealth that you could have had. And this could be a minimum calculation. If your churn is higher or your return is higher and therefore your taxable gains are higher, the gap can even widen. So this 4% yearly gap is huge. For example, in 10 years, 10 lakh investment with 12% CAGR will grow to about 31 lakhs. But with a 4% underperformance, 8% CAGR will leave you with 21.6 lakhs only. That's 9.5 lakhs of lost wealth, simply because of higher churn and taxes in direct stock investing. As per the research, the reason for this was due to overconfidence, overtrading, and poor timing. Now, here's something that most people never think about: the time horizon trap. If you check Nifty 500's return table today, you might see something like this. 1 year return 0.7%, 3 year return 15%, 5 year is 20%. The 1 year investor feels unlucky, the 3 year investor feels smart, 5 year investor is thrilled. But imagine the market moves sideways for the next 2 years. This table could flip a lot. This is again just an illustration to explain this concept. It is not real data. Let's say 1 year is 0.5%, 3 year return is 3%, 5 year is 10%. Suddenly the 3 year investor is also disappointed and he starts selling. Soon after, the 5 year numbers may also look bad, and then there is a mass exit. The result coincides with a market crash and a bottom is formed. So here is this key insight from this. Most people start investing when all the time horizons look great. That is, 1 year is 12%, 3 year 15, 5 year 20. That's when enthusiasm is high and everybody piles in. Historically, these points are often market peak. From there, new investors only see decline in returns or flat returns. Brutal start to direct stock pickers, especially if you are entering at momentum highs. Mutual funds, however, gives you a tool to beat this psychology trap. With SIPs, STPs, SWPs, and valuation-based staggered investing, you can avoid lump summing at the peak. For example, when all three horizons look very, very good, you slow down or pause equity inflows. Instead, you could shift to multi-asset funds or hybrid funds, or park money in low volatility source funds, and then gradually switch from the source fund to equity funds on a weekly basis over a long period of time. This way, both your source fund and your target fund, they keep working for you. One is giving you stability, the other is giving you growth. Now, when 1 year return looks bad and 3 and 5 are still very strong, you increase staggered buying. And when all the three horizons look bad, that's your cue to go all in. Markets are on sale, and history shows these are the moments that set up for your biggest future gains. But stock investors rarely follow such discipline. The emotional swings are too intense, and there is no built-in process to protect them. Again, I must admit this is true for most investors. Still, there will be some exceptions, exceptionally good equity direct investors who are like fund managers. So I'm excluding them from this. Research shows most clearly money is lost because they sell their best performing stocks too early. This is out of fear that they might crash, or they might lose the profit back into the market, or they keep holding on to the losing stocks for too long because of something called loss aversion bias. So these emotional biases quietly eat away at the returns, and they cause long-term underperformance of your portfolio. So without a structured framework, every decision seems to be like an emotional roller coaster. Mutual funds, on the other hand, hardwire the discipline for you through systematic rebalancing, through diversification, through professional oversight. In the end, they don't just outperform most direct stock investors, but they win at one of the game that matters the most, which is protecting you from your own emotion, from your own worst impulses. That's why for most people, mutual funds are not just the safer choice, they are also a very logical choice. Let me give you an example that will help you understand this concept better. Take one of the oldest mutual funds in India, Nippon India Growth Fund Mid Cap. Its NAV today is about 4,400. Its launch was at 10 rupees, that is 400x wealth multiplication. Now, I am directing your attention to something else here. It's not been a smooth ride for this fund. It once crashed 35% in a single month. Its worst 1 year fall was 27%. 10 lakhs invested, you will be seeing 2.7 lakhs vanish on paper in a year. Now, if this was your direct stock portfolio, what would you have done? Most retail investors would have panicked. They would have sold at a loss and they would have never looked back into the market. Let me share a real story from pre-online trading days. Back then, investors would sit in brokers' trading hall, crowding around a single terminal. There was a dealer who would punch the orders for you. I used to visit such halls back then. Once a branch manager told me something that I will never forget. Every market cycle, I see completely different set of faces around this table. Not one survives more than one full cycle. People will make money, they will be there for a while, then get caught in a bad phase, lose heavily, and they will disappear from the markets forever. They never return. Now, here is the difference with mutual funds. The same Nippon fund that fell 35% in a month did not die. It recovered, hit new highs, and kept compounding until 10 rupees NAV became 4,400. Why? Because the funds have a built-in survival mechanism. Diversification, portfolio rebalancing, sector rotation, cash calls, and constant professional oversights. I call this the cockroach effect. Just like cockroaches are said to survive even during a nuclear blast, a well-run mutual fund survives market meltdowns. They come back stronger, thrives again. Direct stocks don't give that built-in resilience for most people unless you're a full-time direct stock investor with a framework like that of a fund manager and analyst to help you. There was another research done by Morningstar called Mind the Gap. When mutual fund investors lost by about 1 to 1.7% per year because of timing. For investors, the takeaway is even while using mutual funds, bad timing and behavior create similar but still significant annual drag versus the fund performance. The point is professional management must be combined with investors' discipline to reduce the drag. There was a very famous saying that comes to my mind. We must all suffer from one of the two pains, either the pain of discipline or the pain of regret. The difference is discipline weighs much lighter, but regret weighs like a ton. Now, if you like the content of this video, please hit the like button, consider subscribing to this channel and sharing it with your friends.